Hi, my name is Michael Corselli. I'm the founder and chairman of FLYA, a 501c6 nonprofit. Today, we're joined here with Bob Elliott of Unlimited Funds. Hi, Bob. How are you today?
Good. How are you doing? Thanks for having me.
It's great. It's always great to have you on our program. So today, we're going to be talking about a very, very, very timely, important topic, um, or topics, factors that are affecting the financial landscape. And we want to provide all the listeners today with the inside track on optimizing their investment strategies, given the fact that we have some factors that no one's really seen before, um, that's not retired from the financial world. Um, Inflation, been in an inflationary cycle in the U.S. is something that is really rare and very, you know, extreme, as we have seen over the past at least year, maybe a little bit longer. And we're going to talk about interest rates. We're going to talk about the outlook for interest rates, Federal Reserve future rate hikes, whether they're going to continue, hit the accelerator, flatten out expectations on any interest rate increases of Fed funds, or actually cut them. And if they're going to cut them, when and what that's going to do to consumer prices, producer price index, and stuff of that nature. So before we begin, though, I wanted to discuss a little bit about unlimited funds, and also give those of you who do not know Bob the opportunity to meet with him and to interact and ask questions. We want this to be an interactive session. We don't want to be just talking, and we want your questions. We want to provide you with insight. We want to provide you with some dialogue, but we want you to be involved in this discussion today. So please pop your questions into the chat or email them to michael@flya.org or jeremy@flya.org, and we'll do our best to get to them. So, Bob, with a time check, how much time do you have today? How much time can we spend talking today?
Oh well, and we can certainly go through five and maybe a little after if people are still interested in what I have to say.
All right. So, Bob, give us a little bit about your background. Tell us a little bit of your professional story.
Yeah. I mean, my background is 20 years as a systematic investor. I was at Bridgewater Associates for a long time, almost 15 years, where I developed a fair number of the strategies in the flagship Pure Alpha Fund, ran Ray Dalio's personal investment research team for a decade, and really was one of the small handful of investors that helped build Bridgewater from being a challenger organization to being the incumbent. I left a few years ago, did a few things, including running a systematic venture capital firm that used big data to find good opportunities, but increasingly realized that the world of 2 and 20 businesses, both hedge funds, private equity, venture capital, are very much they're very good for the manager and not that great for the investor. And so set off to start to think about whether there was a way to bring the low cost indexing concepts that have totally changed, stock and bond investing for most investors, and bring those into the world of 2 and 20. Now, what we do at Unlimited is a little different than many others when it comes to providing access to alternatives. Instead of investing directly in products, which create layers of fees, what we do is we leverage technology and our experience between my co-founder Bruce and I. We have 50 years of experience in the hedge fund business, and we use technology to look over the shoulder of what hedge fund managers are doing in close to real time, and with that understanding, translate that into long and short positions, which we used to back an ETF. Our first ETF, the HFND ETF, seeks to replicate the gross of fees returns of the hedge fund industry at a much more at a much lower cost structure than what a typical 2 and 20 LP position would be. So instead of 2 and 20, we have a management fee of 95 basis points. And because it's in an ETF structure, it has a lot more benefits for the everyday investor. First of all, it's accessible to any investor. They can go invest in HFND as an ETF. And then on top of it, it's much more tax efficient than typical LP positions. And so that's really what we're all about. And Unlimited is bringing that diversified set of hedge fund returns to the market, make them available to everyone at a much lower cost.
So, how do you guys do that? What specifically that do you guys do to actually replicate the returns of these hedge funds?
Yeah, what we do is we take the whole hedge fund industry and we break it down into the major sub strategies. So global macro, fixed income arb, equity long short. We then add back the fees uh, and basically look at the pattern of returns and see that set of returns relative to the investments or the exposures that those managers could have on at any point in time, and we solve for what portfolio best describes the returns that we're seeing in close to real time. And then we take that understanding and translate it into those long and short positions in right now a set of low cost index ETFs, up to 60 different positions or exposures, of which we hold something like 30 to 40 at any point in time. And that's really what serves as the backing of our ETF and what we use to seek to replicate the return profile that that of gross of fees returns of the hedge fund industry. Of course, gross of fees returns is not something anyone can invest in, and so we're trying to make that available to all investors. And so far, it's working pretty well. The technology is tracking the gross of fees returns of the hedge fund industry since its inception. And we've gotten a lot of interest in the product. There's $70 million under management. Almost all of that is from a combination of independent RIAs and family offices, all of who recognize the value in hedge fund style returns, but also understand how hard it is and how expensive it is to get access to the best funds. And so seeing the real advantage to bring this product to a diverse set of clients, many of whom aren't accredited and couldn't invest in these products even if they wanted to, that they can, with the ETF, make those sort of return streams available to everyone. So it was the fastest growing independent actively managed ETF launch of 2022 during obviously a very challenging time. And with 70 million in it in the course of a handful of months, we're pretty happy with the kind of interest we've gotten.
So I find it very unique, the fact that you have decided to put this hedge fund replication strategy into an ETF structure, so it's accessible to everything from retail investors through institutions. Um, how do you see this product fit into a properly diversified portfolio? Like, what is it that you see it like contributing to a diversified portfolio?
Well, I think most investors and advisors out there recognize the value of alternative assets as part of a diversified portfolio. And the reason why that is because while the majority of your risk or return may be structured in something like a 60/40 or liquid securities, a lot of portfolios will benefit on a risk return basis from adding alternative investment structures that offer diversification opportunities without necessarily sacrificing the overall return profile. And so, in many ways, what we sort of think about ourselves as is that sort of low cost index fund type approach to gaining access to hedge fund style returns. That's really what we're trying to do. with the HFND product. And so instead of going out and having to pick individual managers, which many advisors or investors go out and do, instead of having to go pick the individual managers, instead of having to pay the fees and deal with the paperwork and the illiquidity of those LP type structures, what we've done with the HFND ETF is the basic idea is it's if you want hedge fund exposure, you can get it a diversified set of managers and fund strategies in a single product that you can go out and buy on any of the major platforms without having to deal with the paperwork or the other issues that typical LP positions would create.
So I would be remiss not to bring up, one important point that I am aware of, and I know that you're more aware of it than me, but perhaps some of the people are not, is how important is how important is it the fees that you pay to overall returns over time? And I'm sure that you've done some detailed analysis on this. So I'd love to hear, some of your thinking around that.
Yeah, I mean, I think one of the things sometimes investors think about hedge funds and they look at it, they say, the returns aren't that good. And the reason why they say that is because the returns that they often see are net of fees returns. And the problem is, if you take out the fees that these managers are charging, hedge funds over the course of the last 25 years have delivered returns that are in excess of the S&P 500 at monthly volatility that's about half that of the S&P 500, and drawdowns that are at most a third as large as the S&P 500. And so you look at that return profile and you say that's actually a pretty good return profile for many investors. The problem is with most of these funds, they have a fee problem. They don't have a strategy problem. They have a fee problem. And the reason why I say they have a fee problem is if you take that return stream and then you add 220 fees on top of it, well, then you've got something that, it's not that, investors are not that much better off than what they could do on their own. But that's why what we're trying to do is we're trying to deliver that type of return structure. But since we're charging a much lower fee load on it, what it means is the net realized outcome for the investor looks a lot closer to those gross of fees returns for the hedge fund industry than they do the net of fees returns. The biggest thing that you could do in terms of generating alpha for for yourself or for your clients is to get into lower fee products, and that's really what we're all about. In the same way that Vanguard has made buying the S&P 500 easy at 3 basis points, we're trying to provide accessibility to all investors to invest in hedge fund style strategies, at a quarter of the fees and half the taxes of typical LP positions.
Got you. Okay, so um, we want to get into inflation. Let's start out with inflation today. First, we had you on here in December. Then we had you back on again in late January, early February, if I remember correctly. And your view on inflation and the interest rate hikes that were already in the system at that point was different than consensus. So first off, if you don't mind summarizing your view back then, and then talking about if that's changed, like today, what's your current view, and if there's any divergence between there and why.
Yeah, I mean, I think one of the things when we last got together, I think there was a real question of whether or not we were seeing real signs of falling inflation or disinflation. I remember, in early February, Chairman Powell using the word disinflation in the press conference. What was it, like 16 different times? And I think that was in very much, there was a lot of hope in the market that we had gotten through the core inflationary problem, and now we were entering a period of disinflation that would eventually bring it back to the Fed's target. Well, a fair number of things happened since that point, which is that um, the measures of inflation were meaningfully restated, and then since then we've actually gotten indications that some of the disinflationary pressures that had existed a few months ago are starting to reverse. So, as an example, used cars were very important in the disinflation that people were seeing. Well, those prices have reversed. Um, Wage growth, or that category that gets discussed at length, which is the non-housing services category. Those prices, there was some indication that maybe they were starting to fall. Well, now we step back and we look at the picture, and it looks like those are rising and remain well above the Fed's target. And even smaller categories, which had created big disinflationary impulses, like oil prices declining or gas prices declining from $5 a gallon to $3 a gallon. Well, a lot of that's behind us rather than ahead of us, right? The gas price has already fallen, and it would have to fall from $3 to something like $2 or $1.50 in order to get the same disinflationary dynamic in the system. And so what we're left with now is starting to see and feel the structural inflationary pressures and dynamics that sit in our economy. And at its core, when you think about that, there's a basic imbalance that exists in our economy today, in the U.S. economy, which is that wages are growing at somewhere between 5 to 7% on a nominal basis, and depending on exactly what your measure is. And then what the productive capacity of the economy is only growing at something like 1 to 1.5%. And so you see those two different pieces, and you say there's a big imbalance between the nominal spending that's occurring in the economy and the productive capacity growth. And if you put those two things together, that gap, basically, it has to be resolved through higher prices. And that's exactly what we're seeing, which is we're seeing a persistent set of inflation across a number of different factors that are, that's in that sort of 4, 5, 6% range. That's too high for the Fed target, and that still exists. And that probably will exist as long as what we see is a persistence of strength in the labor market, which leads to a persistence of strength in wages. That will continue to lead to high nominal spending relative to the productive capacity of the economy, and that will keep these inflationary pressures in place. And so what that means from a Fed's perspective is that there's still more work to be done. I mean, the reality is, it's pretty easy to get inflation from 9 to 6. The real question is, can the Fed get inflation from 6 to 3? And that is a much harder task, particularly in an environment where we're seeing the sort of wage growth that we're seeing right now. And so those basic dynamics, they haven't really changed much. There's been some nuances of some things that were disinflationary that are now rolling off. And so now what we're sort of seeing as those things ebb is the core underlying structural inflation pressures. And frankly, that's not a very good picture right now.
So you're seeing some of these ebb. What are the ones that are not ebbing?
Yeah, I mean, all of that spending in the non in the non housing non-housing services inflation. So things like medical services, things like transportation services, travel, leisure, hospitality, all of those different categories that frankly are very labor sensitive and are seeing tight labor supply or tight labor markets related to them. Those are all continuing to grow at a relatively elevated pace. The other thing that we're seeing is many of, we sort of were in this sort of cycle related to goods prices where we had a supply shock, good prices went up, that supply shock got resolved, good prices came down. And I'm talking about things like furniture and household consumables and durables and things like that. So we had prices up, and then prices came down as the supply shocks got resolved and inventories got built up or rebuilt. But I think what we're seeing now is that that's reverting to its longer term trend, which is, it's not very high. Those prices aren't very high, but they're not as disinflationary as you saw, in the back half of 2022. And then the final thing I'd emphasize is that the car story, frankly, is it's a very interesting story. We could probably spend an hour just talking about the car and car prices dynamics, with the basic just being that there's still considerable supply constraints, whether it's for new cars or used cars, and the combination of continued nominal wage growth and demand with supply constraints in the vehicle segment is leading to continued elevated vehicle price growth. Whereas 3 years ago no one would buy a car at MSRP, now today every person who buys a new car, well, first of all, is waiting 3 to 6 months to get it and buying it sometimes above MSRP. And so, like, that sort of dynamic, that's a structural supply shock dynamic that continues to lead to elevated prices. Actually, one last thing is, an important part of this whole story also is rents. And rents, in many ways, people say, well, incremental new rents are starting to roll over, starting to decline. That is somewhat true, although meaningfully driven by seasonality. I think the important thing to recognize is rents take forever to reset. So even though asking price rents have come down a little bit, the level of those asking price rents are still well above what the paid rents are. And so and we still have rental costs resetting over time. And so there really is true rent inflation that persists. I was just seeing yesterday some information from Bank of America that actually tracks what individuals are paying in rent, because they know, who the rent companies are that you're paying, and they can track what that rental growth is, and it's still growing at 9% a year. And so that's a very good example. Like, real actual rents being paid by people is still growing at 9% a year. And so, the everyday renter is still feeling that rental price inflation in what they're paying. And so you add that all up, like, it's not a particularly good picture in terms of what's going on with inflation. But at its core, it's that we have tight labor markets, good wage growth, and it's a function of high nominal spending relative to capacity.
So, Bob, can you just give me 1 second? I want to frame a question, and it has to do with food. So, Brian Bailey of the Federal Reserve Bank of Atlanta, he was on the program in October. He said that the Federal Reserve can slow down to a grinding halt the real estate market, big purchases like cars, used cars, new cars, stuff like that. But he acknowledged, I think it was September, October of 2022, that it's going to be hard for them to control food prices. So, how have food prices been going, and what are some of the methods that you see them taming that type of inflation with?
Well, I think that is one of you know uh, I think that is one of the most challenging dynamics that many folks at the Federal Reserve face. Like, particularly when you start to talk about those basic necessities, right? Those basic necessities are the things that hit the lowest income quartiles most significantly. I recently on Twitter highlighted a set of great data driven journalism around the spending patterns and inflation experience of low income earners, and and what it highlighted is that a lot of the things that the lowest income earners are spending on, which frankly is food and transportation, right? That's basically what the lowest income earners are spending on. Those prices have risen a lot more than any other prices in the economy. And the challenge with that from the Federal Reserve standpoint is that it's very difficult for them to directly target those prices. And the reason why that is because food prices, like any commodity, are a function of the supply dynamics against the nominal demand, and so they can't really directly affect food prices because people got to eat. I think that's at its core, and people don't really change their consumption behavior even when there are difficult challenges with supply when it comes to food. And so, from the Fed's perspective, that's a very challenging dynamic. They're really focused on trying to create, by using higher interest rates, they're trying to bring down the prices of other areas of the economy, right? Which are prices of other goods and services in order to get that sort of blended aggregate price growth down in the economy. But they're finding a very, very hard time bringing down some of these food and transportation prices that are the most acutely painful for many Americans.
So if that's the largest percentage of the U.S. Population, um, as far as numbers are concerned, and it directly impacts them the greatest. And interest rate adjustments don't really change. It doesn't change the landscape much. Um, what do you see? How do you visualize them navigating this like conundrum between increasing interest rates and it not having a real impact on helping the lowest like income people, which is that happens to be the highest you know quantity percentage of U.S. population.
Yeah, the folks that are certainly feeling some of the most challenging effects. I should also say that folks in those lower income quintiles are also feeling some of the most extreme effects around rental inflation as well. Stories of rents rising by 50 or 100% over the course of a few year period. I think it's uh, you described this conversation as between a rock and a hard place, and I feel like that's really where the Fed is in the circumstance, and ultimately what they need to do is to prioritize uh, either the fight against inflation, or or a strong labor market. And to the extent that the Fed recognizes that the incipient inflationary pressures are effectively a highly regressive tax that affects basically all Americans at the same time. That they need to recognize that is really, and I think they do recognize that is, the challenges or the costs of inflation are very, very high and broad based and regressive, and the costs of deteriorating the labor market are painful but concentrated and less regressive. And so when they think about how do you move forward, the question is really one of prioritization. Which one do they prioritize? Do they prioritize the labor market, or do they prioritize fighting inflation? I think then the second question is, given that set of priorities, how do they do it most effectively? I think it's very challenging because so much of the economy has a reduced sensitivity on interest rates because mortgages got termed out, refinanced at 2% a year, or 3% a year before interest rates started to rise. Corporations the same way. So there's not a lot of sensitivity, and credit growth, frankly, hasn't been that strong. It wasn't strong even before some of these recent banking issues. And so it's not really a credit-driven cycle the way '08 was, or to some extent the 2000 cycle. This really is like an income-driven cycle, and so you've got to deteriorate the labor market in order to bring wage growth, in order for wage growth to slow. The challenge with that is, in some ways, the flip side of the challenge that they had for 15 years after the financial crisis, which is then it was pretty hard to stimulate demand using the levers that they had through asset prices. Well, now I think what they're seeing is it's pretty hard to contract demand using interest rates, and so they're probably going to need to do more rates. I mean, I've been talking about this for a year, which is that they're going to have to do more tightening than people expect, and they just keep tightening more than people expect over and over and over again, and that they're probably going to have to bring asset prices down more significantly than I think most people expect in order to achieve that goal. And so that is, it is a challenging grind essentially to get the economy to slow down. Because look, the U.S. economy, and one of the great things about the U.S. economy is it's extraordinarily diverse and durable. And what that means is that, I like to say the U.S. economy is like a big tanker ship, right? It keeps going with great momentum, and it takes a lot to slow the economy down. And so the Fed is realizing that, right? Frankly, they've been trying you know, for a year now, and we're probably farther away from recession today than we were 6 months ago because of the momentum that exists in the economy and the strength of nominal wage growth. And so it's going to take a lot more, would be my guess, to get the economy to slow down to the point where it starts to loosen the labor market, starts to hit profits, loosen the labor market, and slow wage growth, and eventually deal with the inflationary problem. And that's the challenge that they face: is that there's a lot more. It seems there's a lot more work to do.
So, if you're a family office out there today thinking about the U.S. economy, what is your projection for GDP growth,
Yeah, I mean,
2023, 2024?
I think we've got a situation where GDP growth, at least for now, is looking okay. Now, what I would separate is just because GDP growth is okay doesn't mean asset price returns will be okay. And the reason why that is because the levers that the Fed has at its disposal, the tools that it has at its disposal to deal with the challenge of inflation that's too high and an economy that has too much momentum directly is through the asset price channel. And so as a result, like as an example, um, right now, what's priced into asset markets is that there's going to be 200 basis points of cuts in interest rates over the course of uh, the next 15 months or something like that. Now, that's connected to a series of events related to the SVB and Associated Bank situation is probably the best way to describe it, rather than crisis. And so all that a bunch of easing is being priced in at a time when all the macroeconomic dynamics uh, point to the need for tighter monetary policy. And so one of the problems is whether you're holding bonds or whether you're holding stocks today, that path of monetary policy is in asset prices. It's in the price of bonds. It's in the price of stocks. And so for those assets to rally further, both the stocks and the bonds, for them to rally further, what you would need interest rates to come in even lower than what's currently priced, right? What you need is for the path of monetary policy to be even lower than hundreds of basis points of cuts in the course of a 12-month period. Well, I'm not sure you want an environment where that's actually transpiring, because then that would start to not just hit the the discount rate, but that would start to hit earnings growth and things like that. And so, for a 60-40 or a stock-heavy investor, that would be a particularly horrific outcome. And so what we're seeing is basically asset prices are too high, right? The Fed needs to bring the economy to slow the economy. The way that they slow the economy is through higher interest rates and lower asset prices. Asset prices remain very high and are discounting the Fed easing in this environment, when all of the different pressures on the economy right now align with a continued path of tightening monetary policy. We haven't slowed the economy down.
So you think that investors today are positioning themselves for a rate cut at a 2% rate cut of Fed funds over what, the next 2 years or the next
Over the next
12 months?
15 months, there's 200 basis points of cuts priced in to the Fed funds curve. And so that essentially, if you're holding bonds today, you are making a bet. Your break-even moment, your break-even point in holding bonds today is 200 basis points of cuts from the Fed over the next 15 months. So
So as it stands today, you're still in line for an inflationary slog, is what I'm hearing you say.
yeah, I mean, I think, yeah, we talked about, we used that term. I guess that was December when we talked about the inflationary slug, and that's basically what we've gotten. If anything, the economy has been than a bit stronger than slug, relative to what we talked about a few months ago. When we talked about in December, I guess 4 months ago, something like that. Um, the economy's been a bit stronger. We're a bit farther away from recession, and all that points to the fact that we need even more tightening of conditions in order to get the slowing of the economy and the easing of those inflationary pressures. And right now, what's being priced into asset markets is totally inconsistent with that. What's being priced into asset markets right now is a massive Fed easing akin to 98. I think 98 is such a good example. And I wrote about this a fair amount on my Twitter. I think 98 is a really good case study in terms of where we are right now, which is a late cycle financial crisis type dynamic. And for those of you who didn't live through 98 or less familiar with it, the failure of long-term capital management created concern about the banking system. That concern was met with a set of 100 basis points of cuts from the Fed. And really, that was in late 98. And what that did is it basically reinflated the economy and asset prices, stock prices, and the economy, and helped create the next 50% leg in the tech bubble. And I think if you look back, the lesson from 98 was don't ease into a late cycle financial crisis because it just reflates or inflates further bubble type dynamics. And remember, at that time, inflation was like 3%. Inflation wasn't even an issue. It wasn't even on the table as being a primary concern. So today, what we're seeing is investors price in a 98 style response, which, to be clear, is looked at today as being an inappropriate response, right? So they're pricing in that's how the Fed is going to behave at a time when inflation today is a problem, and it wasn't a problem back then. So not only was it a bad response in a low inflation environment, that's the synthesis of that policy, but people are expecting that response in a high inflation environment. It doesn't make any sense.
So let's talk about the banking situation, and let's talk about like restricted access to credit, and what that does to rates, what it does to GDP growth and inflation, both
Yeah,
realized and like outlooks. So, if you don't mind.
yeah. I mean, I think there's sort of whenever you think about a financial crisis or a banking system issue, I think there's sort of two important things to think about, which is, well, maybe three. There's the bank itself, which, like, look, SVB, Signature, those are small banks in the scheme. They're hundreds of billions of dollars in a banking system that has $16 trillion of assets. In and of themselves, they're not that big a deal, right? Then there's the question of, do they create contagion to other banks, either through direct financial linkages, which SVB and the other banks, Signature Bank, didn't really have financial linkages to other banks, or through increased concern about investing in holding cash in the banks, or does it create a bank run? I think that initially was a reasonable concern, a meaningful concern, and I wrote about that extensively on the weekend while they were trying to resolve SVB, that there was a real concern that there could be a broader bank run scenario as particularly small businesses started to question whether or not their deposits were safe in the smaller in the smaller banks in the U.S., which represent about a third of the overall banking system. the Fed and the Treasury's response, aggressive response, to ensure that the depositors of SVB were protected, and essentially an implicit commitment that they wouldn't let depositors get hit as a function of short-term bank runs, was, I think, very important in helping arrest what would have been the second and third order consequences or the knock-on effects of a possible broader bank run. To be clear, even with the steps that they took, small banks in the week after SVB failed saw a decline of 2% of their deposits in just a week. So I mean, it's not like there was no bank run. It's just that their efforts really contained the situation. And I think actually, as we're talking here on this, we got the most recent week's Fed balance sheet, which gives you a sense of the sort of credit extensions that they're extending to at-risk banks, and we've basically seen a real stabilization of their various lending programs and the total amount of liquidity that they're providing into the market. And so the run has pretty much stabilized as a result of the aggressive steps by the Fed and the Treasury, and that's a good thing, right? There's no reason to have a bank run. That would be a stupid outcome for this. Now, of course, it's unfortunate that certain particular investors, big depositors in those banks, got bailed out. That is, I would say unfortunate, but there's a trade-off. At the same time, tens of thousands of small businesses also got also got made whole, and it prevented a run on small banks across the U.S., which would have meaningfully hurt small businesses, in all sorts of different ways across the U.S. So when it comes to the trade-offs, that was the trade-off that was made. I think then the last point, so we talked about the banks themselves, didn't really matter. The bank run issue largely contained. And now we talk about the provision of credit. One of the most important things, and people are not talking about the fact, banks have already pulled back their credit extension meaningfully before any of this stuff happened. So both large banks in the US and small banks in the US had slowed their credit extensions to about zero, net zero credit extension, in the first couple of months of 2023. And so to those who are saying there's going to be a big pullback in bank lending, my response is there has been a big pullback in bank lending. It already happened. Now, of course, they can contract their balance sheet. That's a little unusual. It's unusual to actually contract their balance sheet except in extreme crisis environments. And so odds are we're not actually going to see much of a drag. And part of the thing that's very interesting, kind of ties to what we were talking about before, is that growth has actually been okay, even though banks have contracted their lending. And the reason why that is because this is not a credit-driven cycle. You have to keep going back and reminding yourself, this is not a credit-driven cycle. This cycle is an income-driven cycle. It is a wage-driven cycle. And that's totally different from the cycles that we've experienced in our lives, whether it's 08 or 2000, or even the early 90s cycle was a more credit-driven cycle than what we're seeing today. What we're seeing today is much more akin to like a 50s and 60s style cycle. And so as a result, the fact that growth is okay, but credit extension from banks has already slowed, tells you the power and momentum of wage growth driving the strength of this economy. So that's really what we're seeing, is that is really the core dynamic. And so, yeah, you can have small banks pull back, you can have big banks pull back a little bit more, although it's not going to be a big deal. The real question is whether the labor market continues to be strong and whether there continues to be elevated wage growth, both of which are really critical to the persistence of this overall economic strength.
Bob, what do you think about the regulators and their response to guaranteeing the deposits at SVB, and is that in essence a nationalization of the entire banking system?
Well, I think you have to separate the legislative framework from the regulatory framework and response in a crisis environment. The legislative framework with a $250,000 deposit guarantee is essentially proving to be insufficient given the functional realities that many small businesses face. Like, just if you think about it, if you had a small business with 50 people earning the median salary in the US, right? And 50% of your cost was labor costs, you would be paying out something like $250,000 a week. Okay, well, a 50-person business is not that big a business, right? And 50-person business of median earning businesses is not that big a business. And so what it really highlights is that the existing $250,000 guarantee framework, it doesn't really work for small businesses. And so as a result, small businesses are not well protected, is the reality. They're just not well protected. And small businesses and businesses in general, but particularly small businesses, they have to work on they run on banking rails, is what I describe. Like you can't pay your payroll out of a set of treasury bills, right? It's not how it works. Like you have to pay your payroll out of banking account. And so what we see here is an insufficient legislative framework to protect small businesses that doesn't provide sufficient coverage given the size of what those businesses need to even just function in the day to day. At the same time, so you have an insufficient legislative framework. The regulators are sitting there saying, well, we basically have a crisis on our hands around small businesses getting concerned about whether they're going to, there's going to be a run that will hit their deposits in these banks. There's uninsured deposits in these banks, and they really just had no choice, right? Like everyone would say, lots of people would go out there and say, well, it would be nice if they didn't, make the cryptocurrency backing group whole or Roku or things like that. It's like, yeah, it would be nice. Like I think anyone would think, yes, those people who had $500 million in the bank probably were acting imprudently given their level of sophistication. But it's not for a regulator to make that sort of call in the moment of crisis. Regulators are forced to deal with the realities and the trade-offs in the moment. And those realities were such that it was in the public good, in the common good, to protect the depositors. And frankly, go out and go to Capitol Hill and start to talk to legislators about how do we get a better legislative framework in place to protect small businesses and their deposits over time. And so that's the choice that they made, and it was a very practical choice that was required given the pressures that they were seeing on the banking system.
All right, so let's talk expression a little bit, if you don't mind. Um, Given your outlook on inflation and rates and the banking situation that we've just been through, um, how are hedge funds positioning themselves today?
Yeah, I mean, I think the biggest thing that we see with hedge funds these days is that funds are very much there's a lot of uncertainty. That's the reality. Is that there's a lot of uncertainty about how this macroeconomic dynamic will play out over the course of the next 6 or 9 or 12 months. And so when we look at how hedge funds are positioned, what we see is actually they're running some of the lowest risk that they've run over the course of the last 25 years, other than in crisis scenarios. And if anything, the SVB situation and the concerns around whether we're in a financial crisis right now have only exacerbated that uncertainty. While it doesn't look, as an example, it doesn't look to me like SVB will turn out to be, a systemic banking problem. It doesn't mean that there isn't heightened risks given that possibility is on the table. And so really what we see from hedge funds is very conservative positioning, very low risk tolerance right now during this time of uncertainty, because they don't want to overposition in one set of outcomes or another, given the uncertainties at play. And if anything, what happened for many hedge funds is that they got burned a little bit, because coming into the SVB circumstance, they were positioned not significantly, but they were tilted towards later cycle tightening dynamics in terms of their positionings. They were underweight bonds, and they were positioned more towards value-oriented sectors rather than growth-oriented sectors. And so they were positioned for continued late cycle inflationary dynamic. and the SVB situation was like an all of a sudden deflationary crisis that came in and was repricing the economy very, very fast, and that caught many of them off guard. And hedge funds suffered losses as a function of being offside on that, offside on crowded trades that worked in that direction, that flipped in that direction. And so, if anything, that's heightened their awareness of the uncertainties of this environment, given that something may break. We don't know what, but something may break as the tightening continues. And so, it's a period of being conservatively positioned to preserve capital in the event that the macroeconomic cycle plays out, in one of many ways.
So, if U.S. Treasury bonds are supposed to be a conservative investment, and a lot of the dialogue, at least initially coming out of the SVB situation, was pointing to, like poor hedging, of their U.S. government bond portfolio. Um, how do you see the other like 4,000 plus banks that are smaller than them properly hedging interest rate risk?
Yeah, I mean, I think the the general situation is that banks don't take big exposures, big unhedged exposures on interest rates. It's imprudent, and in general, they're not doing it. If you look at the overall unrealized losses on Treasury and agency securities, something like 2/3 or more of those are in the systemically important financial institutions. Those institutions either have hedged their exposure, or to the extent that there have been mark to market adjustments or losses on those assets, that's already flowed into their capital numbers, which then has flowed into their required, raising of capital and capital buffers. So essentially, it's already been mark to market in a way that, SVB, like one of the, nuances of the SVB thing was that, they were taking undue risk, and they were also unregulated. They weren't regulated as a big bank, and so they were sort of like flying under the radar. Plus, they were taking inappropriate risk or imprudent risk, and so you like put that all together. They're a bit of an outlier in this whole circumstance. In general, are there some small banks that are probably have a little too much interest rate risk? Sure. But part of what's happened in terms of the banking circumstance is that the Fed has now provided, through its lending program, an ability for those banks to post those bonds at whatever valuation they currently are at and get par back from the Fed. And that's really important because basically what it does is it means that they can sell the bonds at par, and they're not at risk of taking a mark-to-market loss or creating a liquidity squeeze because of the mark-to-market losses. And that's because bonds bought at par are money good at par, right? Like the bonds, when they mature, will mature at par. That's the way it works. That's a fundamental outcome. And so, really, what the Fed has done is helped alleviate a significant amount of that mark-to-market risk that might exist for those smaller banks.
How will the transition from an era of easy money to tight money affect the overall global economic growth and the stability of financial markets?
Sure. Yeah. I mean, I think um, the big picture is we sort of like lived for 15 years awash in some of the easiest monetary policy that had existed for like thousands of years. And so there are so many pieces and corners of the economy that were built on expectations or on returns that required extraordinarily easy monetary policy. And so those areas, as that monetary policy or as that easy money starts to recede, although there's still a fair amount in the system, but as it starts to recede, we're starting to see what are the nooks and crannies of the economy that we're so reliant on it. So take venture, for example. We're likely to see you know, venture capital returns that are going to be down 70 or 80%. We're going to see, you know, 50, 60, 70% of those businesses fail over the course of the next couple of years. Like that's a good example. It was very dependent on easy money flowing into these businesses. And so, now those ones that were actually bad businesses are going to fail. And so that's what we're going to see is we're going to see a lot of bad businesses fail. But I think in the context of overall the economy is pretty good. Is in pretty good shape. Like most households have termed out and are experiencing, have low mortgages and reasonable labor conditions. Most businesses have termed out their debt, have high cash buffers, and reasonably decent growth. That doesn't mean their stock prices aren't going to fall, but it just means, like, in general, businesses are in pretty good shape from a liquidity perspective. So we're going to see this tightening. We're going to see, frankly, the incremental new businesses that are coming to the market are going to look a lot stronger because they're going to be in an environment where, you can't just take up the easy money and go with it. And most businesses will survive. It's just we're going to see those ones that basically were totally predicated on continuation of easy money. They're going to die. And, there's going to be areas of the economy like venture capital funds and things like that are going to see pretty awful outcomes. Frankly, as they should, because they were bad businesses that were bad uses of money.
So, as a family office, one of the problems, I guess, in this environment is a lot of them hold a considerable amount in that 60-40 model. And in this rising rate environment and the potential negative impact on bond prices, what are some of the options? What are some of the alternatives to like manage that situation if it's coming? Should investors consider?
Yeah, I mean, I think there's a bunch of different approaches that a manager or an investor can take in this sort of circumstance. I mean, the first thing to
Buy
recognize.
HFND.
That's what you said. That's what you said. No,
I'm
I mean, I
sorry.
think
I'm sorry. I didn't mean to interrupt.
no, it's fine. I think one of the things is this isn't a time to take on a lot of risk. There isn't a big penalty for holding cash. If you hold cash, typically you get a bad yield on cash. You pay a penalty for cash. Today, you don't really pay a big penalty for cash, and so it may be a time to increase your cash positions. It doesn't make for great cocktail party talk. Like, oh, I've loaded up on Bill, the Bill ETF. But it's the sort of thing that preserves capital in challenging environments. I think the second thing that you can do as an investor is you can look to add increased diversification at this time, particularly for those assets that might be valuable in an environment where inflation is higher than what people expect. So, if you don't already or haven't considered holding a small portion of your portfolio in, say, commodities, like a diversified commodity basket like BCI, ETF is a good one, K1 ETF that holds commodities, or gold. A lot of different options there. This might be a good time to start to consider those things. And then I think the last question really is, in this sort of environment, for a long time, it was pretty easy to look like you were smart by taking on more risk, right? The kind of, for 15 years, buying the riskiest thing was the most profitable and made you look the smartest. And today we really are transitioning to a world with tighter money and higher interest rates and more challenging macroeconomic conditions, where having real skill at generating alpha can create differentiated returns. And so I think it's an interesting time to start to think about where can you hire alpha? Where can you add alpha to your portfolio? Where are good managers that can generate those returns and help you navigate through this challenging macroeconomic environment? HFND is a diversified portfolio of alpha managers or alpha strategies. It's one possible option, but you should absolutely consider, where do you think there are managers that can generate differentiated returns during these times?
So, like, you've been around the industry a long time. You have a lot of experience. You
Not
know,
that long, Michael. No, I'm kidding.
I'm not
Not
trying
that old.
to age you out. I'm not trying to age you out. I'm trying to channel your inner Ray Dalio. All right,
Yeah,
like,
that's right. That's right.
so, like, what what size portfolio, what size, like, hedge fund, what percentage, not hedge fund, what size portfolio, what size family office, size client, um, you know would you say is a good range to consider HFND as part of their allocation? Um, and
Yeah, I mean, I think.
what percentage of that portfolio should go to into your ETF?
Yeah, yeah. I mean, I think anytime you think about portfolio allocation, you want to think about um, in general, the best returns come from, or in general, your most of the return that you'll experience in a portfolio will probably come from, strategic positions in asset classes, what's called beta, the collection of risk premiums, and so there's ways to do that more or less effectively. But I think in general, that is the most reliable and consistent and frankly cheapest source of return that investors will see. I think the question is basically how much do you, from a portfolio construction question, how much do you want to rely on alpha as a driver of your return? Because alpha is hard to achieve. It's expensive. It's zero sum, and so you have to really believe that you can identify high potential, low cost alphas to bring to your portfolio. But it has the benefit of typically being lower correlation, diversifying, and can provide a higher risk return than typically investing in a diversified beta portfolio. And so, what's the right answer to that question? I think it depends on each individual investor and their view of what alphas they can find, what cost efficient alphas that they can find. If you look at the most sophisticated asset managers in the world, institutions, endowments, foundations, sovereign wealth funds, folks like that, you say they allocate typically about 20% of their portfolios to alpha strategies, the diverse set of alpha strategies. And so, I think that's a good benchmark. And, from our perspective, HFND is one option in that portfolio. You may want to pair it with individual managers that you're excited about, or individual opportunities that you think could be interesting. And so, HFND is really about for investors who are not accredited investors who don't have access to those funds. It may be a useful tool to fill that whole bucket for diversified alpha allocations, or you may pick along with other liquid mutual fund or ETF managers. And then for accredited investors who might be looking at other assets, it can be a beneficial portion of your overall alts bucket.
So, 20 over around 23 years ago, I was selecting managers to allocate to. And I love investing. I love trading. I enjoy it a lot personally. I'm passionate about macroeconomics. I tell people I would do this stuff for free because I love doing it and it doesn't feel like work to me. So you're one of the most exceptional people that I've met in this space. You're a very unique person, and I would definitely hire you as a manager. And I strongly recommend that the people listening look at HFND, look into Bob Elliott and see, you know, what I'm talking about, and you know, agree or disagree. But I think you should definitely consider it in this environment. And I love the views that you have. You early, different than consensus, and right. And today, with the whole banking situation, I believe that you have it right. Um, Even though I want to go chasing a banking crisis. Um, so you mentioned these big funds having 20% allocated to alpha strategies. Your alma mater, Harvard, how much do they allocate to these types of
About
strategies?
about 20% is the the answer is almost always 20%.
Okay, very good, very good. I
Yeah,
love that.
yeah.
All right, so Bob, do you have any concluding comments that you'd like to share?
No, no. I mean, nothing in particular, other than for folks who are interested in what we talked about today, you should definitely check out unlimitedfunds.com, which is our advisor website. It has a blog which you're welcome to sign up for, where where we write about important questions and considerations for advisors, not just about hedge fund performance or things like that, but overall asset management. We also cover what hedge funds are doing in real time and the insight that our technology is delivering. So definitely check that out, unlimitedfunds.com. There's also a link to information about our ETF from that site as well. And then if you're interested in a more day-to-day tactical sense of what's going on. Also, definitely check me out on Twitter. I'm at Bobby Unlimited is my handle, and very active on a day-to-day basis. So if that's something that you're interested in, you should definitely check it out. Follow, ask questions, mix it up. It's always great to see people out there in the world.
Bob, as always, thank you so much for coming on, and I look forward to continuing the dialogue and discussion. It's always great to have you on. Thank you.
Yeah, thanks so much for having me. It was great to talk through all this stuff. Really appreciate it.
And as always, thank you for your time and attention. Good luck investing. Bye now.